What's up, YouTube? Welcome back to my channel. Today, I want to break down the trades that I took this week. I had a phenomenal week on the markets. I want to show you these trades. It was probably my best week of trading in 2023. Sticking to my strategy strictly, discipline and consistency. I'm going to break it all down. I think we can get right into it. So I made most of my trades this week on the QQQ, the NASDAQ. I watch equally the SPY and the QQQ, and I take the setup, which just looks better to me. There's not really any reason to it. I just want to take the setups that are most congruent with my strategy. And that way, I can program in my mind to take the setups that I see and they're the most high quality. So I'll show you exactly what happened. This right here was Monday, 7/17. So starting off, this is what the market looked like as we were opening on Monday morning. Now, to some of you who know about chart patterns, you might notice this chart pattern right here is what I call the head and shoulders, or what is called the head and shoulders chart pattern. And what that shows is there's a left shoulder, a head, and a right shoulder. And you have a critical level here where buyers could not get above and sellers were defending this level. So if sellers do step in at this level, this is where I'm looking to short the market. If they don't step in and if buyers break through, then I will play with those buyers up until the next critical level. This is why I always mention about these if-then statements. So if we can break this level with strength, then I will target the next level. So you always have to have two plans. So if one is invalidated, you immediately switch to the next plan without hesitation or reservation. So this is exactly what happened. Price broke this level. Buyers got above this level. Now I'm looking for an opportunity to play with these buyers. So I'll zoom in here. I'm going to move to the 2-minute chart and show you guys exactly where I entered this trade. So we broke this level. And then we came down and retested this level from the top. And this is where I took my trade long, targeting the next zone. So I made only about 50% on this trade, but the purpose of this trade is to show you that when a level is broken, so instead of waiting around for that head and shoulders to play out, I said, okay, that head and shoulders is invalidated. It's done. What's my next plan? Now I'm looking to play the market long to the upside with these buyers that have now stepped in. So this is where I got long. My stop loss was below this red zone, and I took this trade up, and I got out right here for a 50% profit. Why was this trade profitable for me? Well, I played with buyers. So now, what I used to do in the past is I used to see this head and shoulders chart pattern, and I used to think, I've got to play that short. I've got to play that right shoulder. And I would have taken the market short right here or right here. All of these red candles I would have been looking at and saying, that's my entry short. That's my entry short. Because I could not accept that my plan was invalidated. This is what I mean about having two plans. As soon as one plan becomes invalidated, you need to switch your entire mentality and look the other way. The longer you sit around and wish that the market moved in the direction that you were planning, the more pain you're going to put yourself in under and the more losing trades you're going to put on. So be able to switch up plans. That's very, very important this week. So that was a trade on Monday, a winning trade, only made 55%, but it was still following my process. Now, what's very important to look at this chart right now is this red zone, which was invalidated at this head and shoulders. Now, did I just delete that zone as soon as we blasted through it and invalidated that head and shoulders? No, I left that zone there because these zones are critical moving forward to act as supply and demand zones. Because see, the areas where the chart bounces, these are areas where buyers and sellers agree on price. It's what's called a balance zone or trading sideways. So these zones represent the last known area where buyers and sellers agreed on price. And that's why we have to leave them on the chart. So when price revisits these areas, we can see who is still in control of price. If we, for example, right here, this trade that I took on Monday, buyers pushed up out of that zone. So we know that that is the last place where buyers found significant value in price. So now when price comes back into that zone, we want to see who defends it. Do buyers still think that's a fair price, or are they bearish now, and do they want to see what happens at that level and let sellers take control? So what happened was the very next day, price came down and tagged this zone exactly. Now buyers took control and pushed price back up. Now the reason I did not enter my trade long right here is because we had a strong sell-off early in the morning. Now, I don't know if that's a strong seller. I don't know if that's just trying to scare buyers. But at this point, I do not want to fight that potential seller. So what I do now is I wait till we make it above another critical level. So we break above, buyers prove that they find value at that level, and then I will take the market long on a retest of that level. So this is exactly what happened right at 383.42, which that yellow line right there is yesterday's highs, okay? The high yesterday, 383.49. So I have these plotted out on my chart in a ThinkScript. You can go to my website, Bowman Board of Trade, if you want to download that ThinkScript for yourself. It's under the Resources tab. I will link it in the description below. However, this was yesterday's highs. So I'm thinking if buyers show up here, I want to look for an opportunity to play with these buyers. So what happened is I will let price move up, come down for a small retest, and all of a sudden buyers show up strong in a 5-minute, look at this massive, massive bullish engulfing 5-minute candle at yesterday's highs. So buyers are finding value at yesterday's highs. That is a bullish sign to me. This is where I took the market long. Now, I did exit my trade at 70%. I did not wait for the rest of the day because as you get towards the end of the day on 0-day option contracts, time decay comes in so strong, and any small pullback will diminish your option contracts by 20 to 30%. So I wanted to hold on to as much profit as I possibly could. So I stopped out, or I exited my trade at 70% profit, right around 215. And that is the move that I made. So again, did I capture the entire move? No, I do not need to capture the entire move. If you are trying to capture the very lowest point to the very highest point, that is trading to satisfy your ego. That means that you predicted that the market was going to turn around right here, and that you predicted that the market was going to sell off right here. And let's be real. Can you actually do that? No. And can anybody do that in the market? No. Unless you are a massive institution like BlackRock and you want to buy the market right here and sell it right here. Maybe those are the only people who can actually move the market in that way. You cannot move the market that way. So to enter your trade here is gambling. It's not setting the probabilities in your favor. If the market does move in your direction, that's great. You're going to feel a crazy sense of euphoria, like you somehow knew some trick about the market, when in reality, that was just luck. So the trades that I like to take are not the largest trades, but they are the most probable. And that means that I can do this consistently over the long term. This is so important. I used to think that I needed to capture the largest moves in the market. And after I got burned so many times and I wrote down in my journal, why is this happening? Why is this happening? It's because I felt like I needed to buy the market as soon as it turned around at these inflection points. And if that's something you're struggling with, consider taking the most probable trade, not the largest trade. It may be a smaller trade like this and like the trade I made on Monday. So that is Tuesday. Now, I put on a trade. It was a little bit of a different trade, and I feel like I broke my strategy a little bit. But what I did this day is I saw So this yellow line is yesterday's highs. So in my mind, I'm saying just like yesterday, if we make it above yesterday's highs with strength, I will look to play the market long, right? Because I want to play with the flow of the market. I'm not trying to pick the exact moment that I think sellers are going to come in. That's, like I said, ego trading. I want to play with the trend of the market. I'm playing with exactly what I see in front of my eyes right now. So what I saw here was consistently higher highs and oh man, Thinkorswim's being annoying. I saw consistently higher highs and I saw higher lows. So this right here is what I call a bull flag. And I saw a bull flag and I saw this end of day. This blue price is where price closed the previous day. So if price closed there and now buyers are finding value at that level, I want to play the market higher. So I was expecting this large money to come in. Now, I took the market long about right here. I think it was like 11:40 in the morning because I saw this bull flag and I wanted to capture this breakout of yesterday's highs. Now, as soon as I got in, my stop was below VWAP, okay? And I didn't really have a proper target, which set off red flags in my mind. And when I saw this selling, this is where I put in my trailing stop. I don't often do this, but when I get into a trade and it's not moving the way I want, something just doesn't seem right. I'm not seeing the buying volume come in. I will put in a trailing stop. And what that does is I always put a $16 trailing stop. It happens to work the best for me. But what that does is as price moves up, it brings that trailing stop up behind it. And then the second price knifes down, it will stop me out of my trade right there. So as price goes up, it moves my stop loss up. And then when price comes down, it will save those profits for me. So that's exactly what happened here. This is on the 5-minute chart, but price ran up all of a sudden right to this high. And these sellers came in. You can see this massive volume. They brought price down, stopped me out. I made $15 on this trade, and I think that was like 12% or something. But the key here is if you're not liking price action, if it's not making sense to you and you don't love the setup, put a trailing stop in. It will save your profits, and you don't always get the market right. You know, you don't always get it right. And sometimes you're just going to get into a trade which you don't really love. And this is when you can utilize trailing stops to protect any profits that you might get. Okay. Thursday. So Thursday, well, starting Wednesday, we had a selling. Right? We had this massive selling coming in, creating this supply zone up here. Now, I always love to mark the previous day high, low, and close. That's what these lines are on my chart, right? This is high, end of day, and close. This purple line is close. So now the other thing I always draw on my chart is pre-market high and pre-market low. So what I was seeing here is on Thursday, as we opened up, I'm seeing pre-market high lining up with previous day lows. And we had selling the day before. Selling, and we had consistently lower highs. All right, so this is starting to put me in a bearish state of mind. So I want to now be perceptive to areas where sellers could step into the market. And this is what set me up for a massive win on Thursday. I'm pretty sure it was my biggest trade in 2023. But what happened was I marked these critical levels on my chart, pre-market high and previous day lows. And I waited for price to come back into that area to see who would step into the market. Now, when I zoom into a 2-minute chart, you're going to see within the first 5 minutes of market open. Oh, no, I take that back. This was about first 15 minutes. So this is what the price looked like. This is what the chart looked like. Yes, we found some buying above VWAP, but I did not want to take the market here. I wanted to see what was happening when price came into this critical level that I identified from the day before. That was my camera that just fell off, or my ring light, because I'm being too vigorous here. So price comes up to this level, and immediately I see sellers come into the market. This is where I take the market short, targeting this critical demand zone down below, and my stop was above previous day lows and pre-market high. So this is a critical level where I expect these sellers are going to defend their position. That's exactly what they did, and they brought price all the way down to this level. This was a massive move. Looks like about $5, almost a $4.5 move, and I made 315% on this trade. It was a crazy trade, but I will tell you how I managed to capture this move. This is not a normal move for me. I do not capture 315% moves all the time. This is very rare. This happens maybe once a month, maybe twice a month, if I'm lucky, even less than that. So how did I capture this move? Again, it was with a trailing stop. So the way that I do this is as soon as price makes an initial move away from my entry point, I'm thinking, okay, now sellers are also playing with me. This is a good sign that the market is moving in my direction. So now I'm thinking, if I can lock in 100% profit, so right around here, right around pre-market low, I was around 100% profits. And this is where I put my trailing stop in for $16. And that trailing stop followed price all the way down until my zone. And then buyers came in and knocked me out of the market. That's where it automatically took my profits at 315%. I do not sit around and wait for the market to reach these levels. If I make anything over $100, usually I'm putting in a trailing stop because that is not a normal trade for me. I want to make myself available to any further profits in the market. If it's gonna run further, I want to capture it, but I am not looking to make these crazy kinds of moves consistently. So what I'll do is I'll put a trailing stop in. If I get knocked out, that's perfectly fine. It went past my target. If I don't get knocked out and the market keeps moving in my direction, that trailing stop is going to lock in those profits for me. I don't have to click sell. I don't have to do anything. I don't even have to look at the market. I can just let it do what it does. If it's going to give me more money, it will. If it stops me out, it'll do that too. And that's perfectly fine. And that is what happened today. And I recommend if anybody is having trouble holding on to these trades for longer, because people often ask me, how do you hold on to trades this long? I always just see a little bit of money and I take it initially. I encourage you to try trailing stops. Seriously helped me this day and a couple times this week. I've got one more example on Friday. But this is how I capture these large moves without even clicking the sell button. It just automatically does it for me. And if it stops out, I do not care. I've locked in enough profits. I'm happy with that move. Happy if it kicks me out or if it gives me more money. So that is the benefit of using trailing stops. I highly recommend that. If you're not doing that, look into your platform, research how that works. Okay. Last trade, Friday, another amazing trade. I made 115% on this trade in the first 5 minutes or in the first half an hour of market open. It was absolutely crazy. So again, I had this same level marked out all week that price bounced off of at these critical levels. I've been showing you just about all of my trades have been made off this one critical level that I left on my chart all week. So what happened is, and this lined up with pre-market high. You guys, these critical levels all lining up at the same place provides so much confluence across the charts and conviction in my setup to actually take these moves. Not only was there a supply zone here, not only was it pre-market high, but this was high of day. Price broke pre-market high, failed to hold pre-market high and sold off. So all of these indicators, when this many things line up for me, this is when I am looking to place my trades. These are the high probable setups that I am looking to take consistently in the market. So this is what happens. Price rejects this level, and immediately I don't hardly ever take trades this early in the morning, but this was a perfect setup. I couldn't not take it. I entered short, and my stop loss was above pre-market high, above this zone, and my target was end of day. So this is like a 1-to-4, 1-to-5 risk to reward ratio, which is fantastic for me. So market moves, pulls back slightly, and as soon as we break the low of day with strength, this is when I put my trailing stop in, and it held me all the way down to my target. Now, trailing stops again, I mentioned that before. This is how I lock in these larger profits. I'm also 100% profit is not normal for me. Anywhere between 50 and 70 is what's normal for me. But this week, these trailing stops really did me good. Now, the last thing that I want to explain about how I decrease the amount of emotions that I feel in my trade is by using 5-minute candles. So today, or on this day, Friday, I spotted this trade with the 2-minute candles, like I've got right now pulled up. I saw this trade developing on the 2-minute candles. And as soon as I'm in my trade, as soon as I've clicked buy, I can see that I'm in the trade, I will immediately switch to the 5-minute candles. Now, what that allows me to do is to feel way less emotions from the market. Because if you've got 2-minute or 1-minute candles, they're moving so much that you are much more likely to feel emotions as you're in the trade, and you're much more likely to act out of emotion as opposed to logic, rationality, and following your process. So this is why I love to switch my trade to the 5-minute candles. And what that did for me right here is I entered my trade on this candle, 9:35, 5 minutes into the market open. And immediately after that, there were 2 large green candles right here. Now, instead of freaking out and hovering my finger on the sell button, what I did is I switched to the 5-minute chart, and I said, I am waiting until I see what happens with this 5-minute candle. Like, I need to wait for the 5-minute candle to close before I make any decision on closing this trade. And what happened is in the last 2 minutes of that 5-minute candle forming, a massive seller came in and brought it down, and that is what eventually caused all of these buyers to stop out, and price just magneted down to end of day, which was my target, and I took profits for about 115%. These were some phenomenal trades this week. I hope I explained well how I captured these moves, how I was able to lock in such large profits, and how the confluence across the charts is really what gives me conviction in putting on these trades. I don't just make a trade when I see one indicator telling me that sellers are coming into the market. I need to see pre-market high, previous day low, a supply zone, a lower high, big volume, selling volume, aggressive selling volume coming into the market. These are the things which, when they're all added up together, they set the probabilities way more in my favor, right? Every single trade, I put a stop loss because I know that none of these strategies that I have are 100%. Not one. Nobody anywhere in the entire world has a strategy that works 100% of the time. This is why you need to have a stop loss. And what is a stop loss? A stop loss is the amount of money that you are willing to risk to see if the market moves in your favor. I'm going to say that once more. A stop loss is the amount of money that you are willing to risk to see if the market moves in your favor. Now, once the market does reach your stop loss, you're at the max amount of money you're going to risk. You need to get out of that trade. If you are holding on to that trade, you are unable to admit that you were wrong. You have to be right, and this is going to cause you so much losses in the market. So this is why you need to have a stop loss, and you need to just wait to see what happens at this level. I encourage you to use 5-minute candles to decrease the emotions that you're feeling in your trade. That helped me massively this week. I hope this explanation of all these amazing trades helps you guys. Take it into the next week. Use these tips to your advantage. That's all I got for this week. Have a great week trading. I'll catch you in the next one. Peace.